Hey, how's it going? It's Andy. I did not expect to make a video today. If you've seen the Portland weather at all, it is crazy out here. And before you, as an East Coaster, get on the keyboard and say, "Oh, snow's not that bad. You don't know what's going on." It's different. It just turns into ice here, and it is brutal with the hills, which the Midwest doesn't know anything about. So today, I wanted to talk about 7 investing mistakes that I think that 95% of investors will fall into at some point. Number 6 on this list is the one that took me the longest to get rid of, and I had to make a really concerted effort to stop what I was doing to stop this bad habit. And I think the earlier that you can identify that they are a problem and fix them, it's going to allow you to start your investing journey faster. People want to get on the ground running. They start looking up as many YouTube videos as possible, basically these types of videos, figuring out how to build wealth quickly. And the way that we try to build wealth is by avoiding the major mistakes. These aren't some of the major mistakes that are going to result in your account going from 100% profit to 0% in just the course of a week, but they're the ones that are going to chip away at some of your gains, and it's going to make the early years a lot slower than they would be. So these are going to be ones that if you add to them all together, they're going to hurt you, and so we're going to try to minimize them at all costs. So let me know what were the biggest investing mistakes you've made early on and how you fix them in the comment section down below. Number 1, lack of patience. Investing is hard, and as I talked about, people want to dive right into it. It's the idea of trying to build wealth, and people want money now. If you use this classic psychology question of would you rather have $1 today or $10 like a week from now, a lot of people will pick the now just because it's the instant gratification, and that goes a lot with investing. People are looking for the returns that are going to double their portfolio in a week, a month, and they're not as excited about the 10% returns that are going to build incredible wealth reliably over time. So the lack of patience is the idea of putting yourself into riskier situations than you need to be because you're focused on making the profit now. You're not looking at the long term. You're not looking at something beautiful like dividend stocks that are going to pay out quarterly because that's only every 3 months, and you want to see this constant regeneration and building of your portfolio. So you're looking for get-rich-quick schemes, and that's why you're going on YouTube and looking for videos of stocks that are going to double in a week or a month, and you're going to end up losing a lot of money. So lack of patience, I think, is the easiest one to fall into just because when you start getting a new hobby, you want to dive fully into it and get 100% invested into it, pun intended. And so the idea of getting rid of this mistake is by taking things slow. This is why I recommend people get started with $25 just so one, they can see their money move in real time, but also gives them time to see how they're going to react to their money being in the market, and it allows them to learn more. If you went up to me as an investor when I first started and you looked at my portfolio, you would cringe at it because it's probably awful. Giving yourself time to learn how to invest in the stock market is going to allow you to build a foundation necessary to grow wealth over the long term, and that is mistake number 1 to avoid that most people fall into is lack of patience. Number 2 is trying to time the market. This is a classic one that you'll hear a lot about as the market's fallen in the past year. People don't like buying when the stock market is up. It's the idea of if you went to the store and you saw that something that you wanted went up 10%, 15%, you'd say, not that exciting. But if you go to the store and you see a big sale sign on something you absolutely love, you're more likely to buy it even if it's not something that you need right now. So trying to time the market is a classic example of a mistake that newer investors make. It's the idea of trying to get in at the perfect opportunities because you don't want to buy a stock at a higher price when potentially if you wait longer, it's going to fall further and you're going to get a better discount, which when the stock climbs, it's going to give you better returns. So we have to look at some statistics to kind of figure out how this works, because this is not something where I can look at you and go, you should invest every month, and if you don't, you're probably not going to maximize your returns because you're looking for the best opportunities possible. You've seen the market fall 20% in the past year, so you could understandably assume that the stock market could fall another 10%. So why would you buy now if it's going to fall further? So this is an example of trying to time the market. So there's 5 different examples. There's the perfect timing. So these are people that are investing $2,000 annually, and they're doing it in different ways. You have someone that invests the first day of the year. You have someone that invests the first day of every month and spreads it out across the year. You have someone who buys the perfect bottom of the stock market. So if the stock market is up and down, it's going to buy on the perfect day, even though your normal investor is not going to know when the bottom is. You're going to have someone that has the worst timing. They're going to buy at the very top of the year. And then you have someone that's going to be staying in cash and is going to, stick things out and kind of wait on the sidelines for the perfect opportunity. And over time, I'll put up on the screen right now how the returns have differed over time. You can see that the perfect timing, as you would expect, has the highest returns at 151,000. But when you compare the investing immediately, meaning that you're investing your money on the first day of the year compared to dollar cost averaging, which is the idea of constantly spreading it across the different time frame. It could be a week, it could be a month, it could be a year. It's the idea of spreading it out and just buying no matter what the current price is. Those are pretty much identical in their returns. And then you look at the bad timing. This is someone that is buying at the worst opportunity of the year. They're still doing incredibly well compared to sitting in cash. Sitting in cash is not going to allow you to build wealth. But the difference between bad timing and investing immediately is not as large as you might have thought. So what's the moral of the story from here? The moral of the story is trying to time the market is not worth it. The best way that I found is dollar cost averaging because it gives me excitement to buy constantly versus putting all your money in on the first of the year. And statistically, it's shown that it is not that different investing at the very beginning of the year versus spreading it out. So if you want the benefits of trying to buy when the stock market's down, I personally love the idea of dollar cost averaging. It spreads it out over time. And when you see the stock market go down significantly, you can throw some extra money in there. But the moral of the story is trying to time the market. You're probably not going to be that great at it. It's more beneficial to try to throw your money in earlier rather than later. Timing the market beats timing the market every time. And that's what we're trying to get across in mistake number 2. Let's go to number 3 is lack of diversification. This has become a problem that has really compounded in the past couple years with the rise of the meme stocks and the tech stocks going pretty much vertical in the past 5+ years. Diversification is the idea of not having all of your eggs in one basket. The idea behind this is if you have all your eggs in one basket and you trip and fall, something is going to destroy it all and then you're going to have nothing remaining. Diversification allows you to weather the storm in various market conditions. So when you look at a recession, it's going to be caused by different things, and every recession or market downturn is going to be caused by something different. And you're really not going to know what the catalyst is going to be until it happens. So the way that we try to avoid that is by diversifying our portfolio to protect ourselves in all courses that the market could go. This is why if you buy into the tech stocks, which have been incredibly profitable for the past 5+ years, you've probably had a really tough year and a half as the market conditions with the microchips has been really the hindrance and the catalyst for having the market slide significantly. That's why the NASDAQ, which is the tech-heavy index, is down so much more than the S&P 500, which is a diversified market cap of various industries and companies. So this is the idea of trying to spread things out. People buy stocks that they know and love, and for most young people, which are most of the demographics that are watching my videos, they're buying into tech stocks, and as a result, they've all kind of gone down with the ship. One of the ways you can avoid this is by buying whole market ETFs. That's why I buy QQQ, which is the tech-heavy index, because I think for the long term, that's going to be the best place to have my money. But I also spread it out with the S&P 500 ETF, just so that when individual stocks have a rough day, it's not going to pull down my portfolio completely. You can go on the internet, especially on Wall Street Bets, and you'll see the Robinhood snapshots of their day. And 100% of their portfolio is put into one stock. That means that you're riding and dying with that stock. If things go well, it's going to be fantastic, but most likely you could have a bad day and your portfolio is going to be down 5%, which is unlikely to happen if you are diversified correctly. So that's going to be number 3, lack of diversification. Number 4 is emotional investing / fear of missing out, or FOMO. This is one that I had to deal with a lot and has become increasingly common with the social media age. I just think of the Dogecoin boom and the GameStop boom of, January of 2021. It's the idea of people that you know and trust are talking about a get-rich-quick scheme. Basically, people are putting money into the stock market, into these pretty risky investments and making a lot of money. And as a result, all of your intuition and reason goes out the window and you're just trying to buy in so that you don't miss out. Emotional investing has become so much more difficult with social media because everyone has an opinion and everyone's trying to push the same stock that they're buying, because if people are buying it in the same direction, the stock price is going to go up and they're going to make money. So it wouldn't make sense for someone who's invested in a stock to say, yeah, I don't know, maybe not a great stock. Everyone's going to be pushing it because everyone has their own agenda to try to make money. So the way that I try to avoid this is by giving myself the 24-hour rule. It's the idea of any decision that I want to make. It could be buying, a new video game. It could be, buying an outdoor equipment, like a new fishing rod, or a stock. I give myself 24 hours by the time that I've decided, yeah, I'd like to buy this, and just kind of sit on it for a little bit, because the impulsive decisions that you can make it so much easier to hit the buy button or sell button. In this case, we're trying to avoid selling stocks at a loss because of a bad report or a bad stock market day where things are down significantly. But giving myself the 24 hours historically has been a great way to deter me from having these emotional responses. And if at the end of 24 hours I still want to go ahead with the action, that's okay. That means that I thought it out and I'm not going to have this impulsive decision that's going to be a huge regret in the future. So 24-hour rule is the way that I avoid that. And that's number 4 on this list, which is going to be emotional trading, or FOMO, fear of missing out. Number 5 is not having an investing timeline. Not all investing portfolios are made the same. You can look at a retirement account and have a normal trading account. They could have the same stocks in it, but they have very different timetables, and I think it's really important to know what your time frame is before you go and start investing in specific stocks. When I talk about my retirement account, you think retirement, you want it to be slow and steady. I kind of think about it the other way. Retirement accounts are going to be needed for me 40 years from now, so I want to be aggressive. And if I buy a stock that's going to be down for the next 5 years, but it's going to go up significantly 5 years from that, I'm totally okay with that because I'm not going to touch that investment anytime soon. That's very different than my normal investing portfolio, which is earmarked to hopefully put a down payment down for a house that I'm going to need hopefully in the next 2 to 5 years. So if I bought into a stock that could be down significantly in the next 5 years, that's fine for my retirement account. But for my house fund, that means I'm going to be set back significantly in my down payment. That's either going to mean I have to wait longer to buy the house, or it means that I'm going to have to put a much smaller down payment or a smaller house. So it's important to kind of know what you're investing for and then tailor your risk management strategy around that. So I have various investment portfolios. I have my crypto, which I've been holding for like 6 years at this point, which has always been earmarked for my retirement account, which is why I'm not trying to trade it. I'm just holding it for the long term. I have my retirement account, which I'm going to need in 40 plus years, so I'm pretty aggressive with it. And then I have my dividend investing portfolio that I've talked about on this channel, which is mainly going to be used for a down payment on a house, and I want to keep it relatively safe, which is why I've diversified it with dividend aristocrats and dividend kings, stuff that's going to be pretty reliable no matter what the market conditions are. So not having an investing timeline, I think you need to take a step back and kind of think, what is this money going to be used for? If you're not going to need it for the next 10 plus years, you can be more aggressive with it. But if you're going to need it sooner, it'd be a real shame if you invested this money and it was still down 5 years from now, because based off of market conditions, that is very possible. The market has done incredibly well over the past, 20 years. But it's possible that the stock market could be down 3 years from now, and when you need your money, it's going to be down in value. So that's going to be number 5 on this list, not having an investing timeline. Number 6 is going to be constantly watching the market. This is the one that I talked about at the very beginning of the video. That was something that I fell for pretty bad when I got started in the stock market. I started watching the market pretty much daily. I was not only invested in 2 risky positions that would go up or down 5% on any given day, and they were leveraged ETFs, which it just makes me cringe to think that I used to do that. But it was the idea that my money was growing and mainly falling in real time, and I wanted to see what was going on at pretty much any given second. I used to remember I'd leave for class. It was probably a 15-minute walk. I'd check it on the way there. I'd check it right before I went into class, and then I'd even take a quick little peek at my phone during the lecture just because I was curious to see if anything happened that I would need to sell out of, which not a healthy thing for anyone to pretty much be doing. But on the less extreme end, this is someone that is checking the market multiple times a day and kind of seeing how their money is changing in real time. The way that I've kind of avoided having this obsession about checking it is, one, I've deleted apps off my phone for a long time just so I didn't have that opportunity to check it. And now I only check once a day just to kind of see what the major stories have been for that day. And I think that has made me create a much healthier relationship with investing instead of this obsessive addiction about checking to see how my money has changed in the course of 30 minutes since I checked it last. And so with the ability of technology to look at the stock market at any given time, see how your portfolio is moving, I think people fall into this habit a lot, and I'm likely not the only one. That's why I wanted to talk about the ways that I avoided that, getting those apps off your phone and only checking it once a day if you have to. It's healthier to just kind of avoid it. If you're investing for the long term and you're in reliable stocks, nothing crazy is going to happen in any given day. Any decision that you need to make today based off your emotional response likely can happen a couple days from now, and it's not going to be that big of a deal. So that's how I have avoided constantly checking the market, because it is really an obsession, and I've made videos in the past talking about how I was addicted to the stock market, and checking my phone constantly was part of the thing that kind of opened my eyes to see, ooh, yeah, I do have a problem. So that's how I have tried to fix number 6, constantly watching the market. Now let's go to number 7 and the final one on this list, which is following the crowd on social media. I've talked about social media a couple times. It is fantastic for increasing awareness about investing in the stock market. That's why my channel boomed in 2020, because so many new eyes were looking about how to invest in the stock market as they were staying at home when the pandemic began. But now we've gotten to the point where people have kind of gotten used to how the market works, and they're looking for the next hottest play. You have people that are, tracking stock picks of this option is going to go up in volatility aggressively in the next couple hours. You got to buy now. And you have all these people that are trying to get you to invest the same way that they are. And I think it's really important to take a step back and have a set plan of how you're going to invest, because just like how every portfolio needs to be different, every investor needs to be thinking differently. Just because a bunch of people are buying one stock doesn't mean that it is a great investment. You can look at the GameStop situation where a lot of people made a lot of money because the stock skyrocketed in price. And then there were a lot of people that saw all the articles and Reddit posts about how if we hold on, it's going to continue to go to the moon. And now people are stuck holding the bag and are down significantly on their position. So looking at social media can be a positive to kind of see where people's sentiment is at. But if you're trading based off of a YouTuber's recommendation, people that you're seeing talking about it on a forum, you're likely not investing based in your best interest, and you're investing emotionally, which kind of ties in with the social media aspect of it. Just because information is so readily available, it's so easy to find a positive story about something, and especially the confirmation bias, where if you're looking for a positive thing about your specific stock, you can find it. You can probably don't even have to dig that far. For every positive story that you see about Tesla, you can find a negative one about it as well. And depending on which side you're on, you're probably going to watch more of those. And I think that's why checking social media and following it as an investor is a disastrous way to go when it comes to investing. Those are my 7 investing mistakes that I think that most people fall into when they get started investing in the stock market. I'd say number 6, constantly watching the market, was the one that took me the longest time to get rid of, just because it became so ingrained in my muscle memory of if I had a second of downtime, I would check it. That's why I made it such an effort to delete the apps off my phone, so I would be much better about not checking my phone. But I think pretty much everyone can have an example of these. I'd be very curious to hear what people's thoughts are on this list, and if there are mistakes that you found yourself constantly making that took you a while to get past, or what you're currently dealing with. I'd be very curious, so let me know in the comment section down below. If you made it this far, please hit that like and subscribe button, as would help my channel out a lot. And if you have suggestions for other topics you'd like me to cover in the future, be sure to let me know down below. My name is Andy. We're here to make investing as accessible as possible, and I will see you in the next video. Thanks for watching.